Yeah, Monday. What's up, everybody? Monday morning. Welcome to today's edition of the Daily Market Commentary. I'm your host, Chuck Fulkerson. Hope everybody had a great weekend as we are about to roll into the week. Market set some new highs last week, but we did see a little bit of divergence. Hopefully, you saw our weekend review and weekend preview video where we talked a little bit about what the family is doing as far as the Russell moving away from the other markets. And so, overnight, we're down just a little bit, not a ton, but down a little bit. And so let's go ahead and go and dive right in, starting with the big picture. So let's take a look at the ES, which is our S&P market. Now, last night we did have a live trade room, and in our live trade room, we talked about in the ES that we had really two areas to look at. Now, I will say that we've got this area of supply marked, but we didn't have that area of supply marked as a short opportunity. I don't want to trade the S&P in that kind of a position because it's really going to be a lower probability entry. I was actually looking at this as a target from our long. Now, the long did give us a not quite a 2-to-1 reward to risk off of this hourly level right here. I will say, however, that I'm not overly impressed with the movement that we've gotten out of here. And so if you took this long, if you happen to be awake and took this long, I would say take your stop, move it to break even at this point. I know we normally want to wait for 6 candles, but I think it may be healthy to move your stop to break even at this point to so that you have essentially no more risk left in that position. I feel like that's probably going to be the smarter play on this particular trade. So I'm going to remove this line here. So take your stop, move it to break even, and then what about the rest of the day? Well, for the rest of the day, on our 4-hour chart, we are still in an uptrend. So I'm really having a hard time justifying looking for shorts. And so when I look at longs, if this one doesn't hold, I've got a really nice one up in here. So I'm okay with going short, provided that I get enough basing and you get a breakdown. If you do get a quality reversal where you want to try a short, um, and I think that might be all right as long as you do it on a 15-minute time period, you may actually get a little touch back to this little wick over wick noisy cricket level because I don't believe that the demand level that we looked at in the hourly chart is going to hold. That's why I said move your stop to break even or maybe even take a little money off the table. I mean, if you got long down here, 5 or 6 points isn't going to hurt you. So hopefully I can get this video out quick enough that you can see it. All right. Next, the NASDAQ. Looking at the NASDAQ, not a whole lot in the NASDAQ positioning as far as trade opportunities. If I look at this on the daily chart, you can see that we are bumping our head up against the all-time high, but we're not quite there yet. Quality demand, in my mind, doesn't come into play until down here on a 15-minute. You can see the little unbalanced wick over wick somewhere down in there. Is there an opportunity to trade all the way down lower than this? Sure. And so look for a potential breakdown below 15,060. That's where we bounced off of last night. Could be a little bit of a bear trap, though, with a little demand down here. So just be aware of that. It is a potential. Crude oil. So we did look at crude oil last night and found a nice little 15-minute zone for a potential short. And price hit that zone and moved away brilliantly. So hopefully those of you that were awake, I was not one of those people that were awake. But if you were across the pond, or maybe you're a night owl, maybe you were able to catch this move as it really hit our base drop level, hit that zone and then moved down. We actually looked also at a potential breakdown below this line, and we got a little run down. So this gave you actually two nice short entries last evening. And so I need to remove this level because we traded all the way to the top of that area. But I will also add in this little wick over wick beauty right here in case we come back in and retest this level. All right, and then gold. Now, gold, unfortunately, last night I looked at this area here for a potential breakout trade on a 15-minute chart, as it was giving me a really nice potential triangle breakout. We got a little hit, and then it just kind of meh, right? If you took it on a breakout, 1, 2, 3, 4, 5, 6 candles later, although your stop is probably going to be down below here at its tightest point anyway, so you got a quick stop out on this one, 3 points. Hopefully, you didn't load up on it, wasn't too bad. But that one did unfortunately not follow through. Now I think there's chance that we can see price continue to make it all the way down into these two 15-minute areas of demand that we have identified. On the way down there, though, let's take a look and see if we get a little rally back up into this supply area. Now, overall, gold is a little bit meh on our 4 hour. It's not a beautiful picture, but that's right now that would be a decent pullback into decent demand for price to then rally higher. So, if you want to take the 15-minute short, you do have an opportunity up there. It's a little slower, a little smaller of a level. I mean, that's only like 2.5 points in gold, which is fairly tight. Once again, always with these, if this one's too big, you can certainly trade the micro contract in these if this winds up getting a bit too big for your flavor. So those are our 4 markets that I have out there this morning. If you guys have any questions on those, great. But let's take a look at our stock of the day. We've got a specialty today. Stock of the day. Our stock of the day is Equity Residential. Now, this is a REIT. This REIT just came out with earnings, had earnings that were a little higher than what were expected from an estimated earnings amount. It was a little lower in earnings than the prior year, but we are in a pretty nice, solid trend channel. Now, I don't really, do much trend channel bouncing, but this is a pretty good one that we can see the trend channel that's been formed. For those of you that use those, that's actually a pretty clean line that we're seeing. And this is a nice little pullback here into an area of demand and a fair price value zone. So if you wanted to go long on this one today, I would need to get above Friday's high, and your stop, in my mind, goes just below last week's low. So your stop is below this candle's low, and the low on here is 81.49. So a stop just below the low, and then along somewhere up above the Friday's high here on the 13th. That should give you a good bounce off of that rising trend line, but really it's also reacting to this old area of resistance acting as new support, and you have a quality area that price could bounce off of. If I were to throw on a quick, I haven't looked at this yet, but I just, in my brain, I thought I would take a look at this to see. We are in the bull area, bouncing off of a rising 50-day moving average. So in the bull area, bouncing off a rising 50-day moving average at an old area of support and at a rising trend line. So lots of things coming into play here from traditional technical analysis standpoints. If you're looking at this from an options perspective, I think that your best options play is just to go out and get the October 80 options. They are a little bit in the money, 0.64 delta. That's actually a little deeper than I like to go. I typically like to go slightly out of the money. So if you want a little bit more speculation, you can go to the 85 options. The 85 calls are gonna only run you about $1.65. 36 delta though is a little on the low side. So whether you do the 85 or the 80s, both of them have a spread of less than 10% of the premium. So I'm okay with that. Although the spread is right at 10% of the premium, and they both have open interest of over 100. This is not a super liquid option, but there is enough liquidity in order to make this trade. I do find it a little bit interesting that we have a little bit more open interest on our puts than we do on our calls. And I'm wondering if that is selling puts for acquisition in this stock, because it's in a nice, strong upward trend. If I throw my implied volatility on there, oops, that's not what I wanted to throw on there. If I throw my implied volatility on there, that's still not what I wanted to do. 0 for 2. That's better. We can see that our implied volatility is at the lowest point of the year. So I don't see a real reason to be selling puts or to be selling options on this one. I think that it's okay just to go out and straight buy the call, either the 80 or the 85 long call. Now, if that 85 long call, you decide to take that position, where do I place my stop and target? Well, if this is my trend channel, price comes up and we really just look at this as the channel, and I think it's very realistic to have a potential profit target somewhere right about here at about 90. So I think 90 is a good profit target. So in this case, you'd be looking at an entry of 81, call it 82.93. So actually, you could go a little lower than that. Our previous high on this was 82.81. So yeah, about 82.93 for an entry. Stop at 81.46, and a target somewhere up around 90. I think is a good target too. For target 1, I think you'd probably be good to go about a 2-to-1 reward to risk. So let's call it somewhere right in here for target number 1. So let's take that and look at it on the options position. So if I were to do let's look at the 85. If I do the 85 call, and I've got a stop at 81.46. We can see that this would be our options risk graph. And then if I've got a target at 86.18 and 89.43, so 86.18 and 89.43, call it just south of 90. All right, so in this case, if we go halfway between now and expiration, I always like to give it a little bit of time to make its move. So let's go out until, let's call it September 20th. We'll go out till September the 20th. So on September the 20th, if it hits our stop, on this particular one, we're risking about 48 bucks. If it hits our stop loss, we're going to, risk about $115 if it hits our stop, looking at our September 20th option. And we're looking down there at the bottom left-hand corner where it shows my P&L. The P&L, if it gets there today, we lose 48 bucks. If it gets there September 20th, we lose 115. This actually only winds up at my target, getting me at my break-even position, right? My target gets me a profit of $72, and target 2 is a profit of $353. So my real target, my price target of a 2-to-1 definitely hits my objective of a 2-to-1 reward to risk, a little greater than 2-to-1 at my profit objective. But my first target does not, right? It's not going to get me quite there if it takes me a full month. If it happens very quickly, I'm risking $48 to make 153. So really, this is where time decay comes into play. Is time decay going to be an issue on this one? It looks to be that it could be a little bit of an issue with a time decay piece. Let me take a look real quick. The other thing that you could do is you could do a vertical spread. And if I do the vertical spread, the 82.50 by 87.50, it's going to be a $2 debit on a $5 spread. Turn this one off. In this case, you'd risk 78 at the first target, risk 78 to make 108, uh, risk 70, excuse me, risk 33 on the first day, risk 33 to make 99 at the first target. Now, but for the first target, but the second date, you're risking 78 to make 111. So, um, in this case, I actually think that the bull call spread is actually a better trade and a better play. So the 82.50 by 87.50 bull call spread actually is going to profit you a bit faster, and it's going to be the better trade than the long call. Now, the long call gives you the advantage of unlimited profit potential if you plan on holding it beyond your target of 90, but that's really only until the middle of October, early October anyway. And so it's completely up to you as far as which direction that you would want to take it. I think if you think that this thing can continue to run and go to 100, then the long call is the better play. If you want to make the play with your target up here at 90, then I think that the bull call spread's probably better because you're looking for a quick swing trade, and you're just going to get you a quick 2-to-1 reward to risk. So that's our level. Hopefully that one makes sense. If you guys have any questions, as always, send us an email. Support@tradersarmy.com. Until tomorrow, everybody, I'll talk to you soon. See ya. Hey, thanks for joining us. If you like what we do, please make sure you hit that subscribe button. It's the only way the computers know that you're actually alive and really care. And go to tradersarmy.com today to learn a bit more. And if you want to see some of our other videos, click here in the box.